Welcome to trading the weekly and monthly pivots. The what, why, and how behind them, we'll discuss this. Essentially, a pivot point, regardless of what time frame you're looking at, is regarded as a key technical turning point. And like with many technical indicators, it's just another reason in support of the trade. We can also use pivots to determine where the overall trend or context of the market actually is, and we can do this on any time frame. So, for example, if you trade the smaller time frames, you can look at the daily pivot. That has quite a lot of significance. However, if you trade the daily and above, then you would obviously be a little bit more interested with the weekly and the monthly pivot. Because the higher the pivot, or the higher the time frame that corresponds with the pivot, the more strength it's likely to command over the price action. However, as we're only end-of-day traders, we should only really be concerned with the weekly and the monthly pivots and as to where they are at and how we can essentially profit from them. We don't need to worry about pivots corresponding with any smaller time frames, like the daily pivot, for example. And if you're just wondering how pivots are worked out, well, essentially, if you look at the following equation, the previous period of times, high, low, and close, divided by 3, that will give you the pivot points for that period of time. So, for example, if we're looking for the weekly pivot, or we want to know the level of the weekly pivot, then we look at last week's closing bars, high, low, and close divided by 3. It's exactly the same if you want to work out the daily pivot level. We just look at the previous day's high, low, and close divided by 3, and the same with the monthly. Say, for example, we're in November, and we want to basically calculate the monthly pivot points, then all we need to do is look at October's high, low, and close in price, divide that by 3, and we've got November's pivot. However, you'll find that most charting packages work this out automatically, so don't worry. So we've dealt with what a pivot is, but why do we use them? More crucially, well, they essentially give us another valid technical reason to go short or long. Like with any other technical indicator, they can give us an extra reason to get into a trade. So, for example, we've got a reversal bar bouncing against a pivot, or the weekly pivot, or the monthly pivot, and it also happens to coincide with the Fibonacci level and the moving average. Then great, we've got an extra reason to get into the trade. A weekly and monthly or daily pivot is essentially a psychological line in the sand. Some people look at them, but not everyone. So just like with our argument to build up the case for a trade, we want as many factors as possible to line up in support of our decision to take the trade. They also represent hidden levels of support and resistance, which is great based on the equation I just told you. And they give us an overall scope for the context of the market. In a downward trend, we can reasonably expect the price action in phase 1 to be below the weekly and the monthly pivots, and vice versa. In an upward trend, we can say objectively that the price action is going to be above the weekly and the monthly pivots. It's a good confirmation. And I just want to preempt this question. Which is more important, the weekly or the monthly? Well, through years of experience in trading the markets, the weekly and monthly pivot is as valid as each other. So we get a trading opportunity, and we've got a reversal bar tested against the weekly or the monthly pivot. It doesn't matter whether it's the weekly or the monthly. Both, as far as reasons are concerned to trade it short or long, are as valid as each other. So here we go. We can use weekly and monthly pivots to objectively tell us that we're in a downward trend. Like, for example, here, phase 1, we can use weekly and monthly pivots to show us objectively that we're in phase 1 of a downward trend. And we can simply say, well, we can say here we've got phase 1 being the extension, being the lower high to the lower low, followed by phase 2. We could say that if we wanted to use the weekly and monthly pivots with this, we could say that we're not in phase 1 until we're below both the weekly and the monthly pivots, like we are here when you have this very nice run all the way down here. So you can see here that the price action is consistently below both the weekly and the monthly pivots when we're confirmed to be in phase 1, i.e. with the prevailing trend and extending to the downside, having made a lower high to a lower low in a downward trend. And it's the same principle as in the upward trend as well, except the other way around. It's like, for example, we've got phase 1 being the extension, phase 2 being the retracement, phase 1 the extension, phase 2 the retracement. we can use the weekly and the monthly pivots to quantify to us objectively that we are in phase one, as and when price action has left the phase two retracement in order to make a higher high in this case and be in phase one until that point is met. So it's the same principle as we've just seen before. If we're in an upward trend and we want to trade phase one, we could objectively say the price action is above the weekly and the monthly pivots, and that's a very good objective measure for that. So how do we trade this? Well, as we just mentioned, we don't want to trade the weekly or the monthly pivots unless we have a confluence of other reasons, or just another reason. Pivots are not strong enough to trade by themselves if we're trading the daily. Just like a debate in Parliament, the more reasons or the more kind of evidence we have for a trade, the more self-fulfilling the move in our direction generally is. But if we've just got flimsy evidence or just one reason, then the argument's hardly convincing. But let me show you this in context. So here we go. We have New Zealand yen, a currency pair which has been range bound for quite some time, and we're at the top of the range here at a big psychological round number, 6,900, and we are just about to move all the way down here to presumably the bottom of the range, looking at how it's behaved in the past. So we can see that we've had the initial fall and we've had the retracement. We've got a bearish pin bar reversal, which is rejecting not only the weekly pivot, but also the monthly as well. And this is really quite significant if it's rejecting both. But what else do we have in support of this? Let's find out. So let us migrate to eSignal and just show you this in context. Over the past several years, 3 years, we've been sandwiched between a key level of resistance and support here. So it makes a lot of sense to reasonably consider this one as a continuation to the downside here, from hitting and reacting to the top of the range down to the very bottom. We've got our bearish pin bar reversal, rejecting not only the weekly or the monthly pivot here, but what other reasons do we have to go short, apart from the fact that we've just employed the simple logic of selling near enough to the top of the range in advance of taking it down to the midpoint or even 3/4 of the way down? What else do we have in this? Obviously, it would have been better if we called it at the very top, but for the sake of this trading the weekly and the pivot example, let's see what else we can have in agreement with the weekly and the monthly pivot. Let's try the Fibonacci. Great, we've got a 50% Fibonacci retracement. That's one factor in the box. The fact that it's a bearish pin bar reversal is another filter which has been met. A very good bearish signal, and it has got a lower high on the hourly time frame as well. And another factor is that we've just got a very minor, even though it's not significant, we've got a minor trend line here with the 1, 2, third touches, or 4 touches if we include this, just touches here. 4 touches along this. So we've got several factors agreeing with the weekly and the monthly pivot here. So it looks like a very good trade for that reason. So you can see here how we've basically mixed together a combination of factors in order to support this, or the case for this trade being a decent short move. The fact that the price action is below both the weekly and the monthly pivot as well is a good confirmation that it will continue to the downside, because it is quite significant if price action breaks and closes above or below the weekly and monthly pivots. And this, combined with the overall market structure and the fact that we're in the top 6th or 7th of this range here, points to a very convincing short all the way down. So here we go, we've got it summarized here. The more reasons we have in support of a trade, the better, quite frankly. Let's try another example here. Let's look at an upward trend now. We can see that price action is cycling, making higher highs and higher lows, and is for the most part above both the weekly and the monthly pivots here. We've got a phase 2 retracement back to the monthly pivot and a bullish pin bar reversal off the monthly pivot as well, which is a good signal for a long position. This is the FTSE 100, and we're making higher highs and higher lows. So we can reasonably expect, based on cyclicity alone, that we've got good bullish momentum continuing to the upside here. But what else can we actually look at here to support the trade? That's the question. So let's build up the case for this trade long, in addition to the fact that we've got a bullish pin bar reversal off the monthly pivot. Let's take our Fibonacci retracement from the most recent swing low to the most recent swing high. We can see it's respecting the 0.786 Fibonacci retracement level. That's fine. Let's take it from the second most recent swing low to the most recent swing high. And we can see that, okay, it's also respecting the 50% Fibonacci level as well, from this swing low to this swing high. So we've got a Fibonacci cluster here. And we'll discuss Fibonacci clusters in the Fibonacci cluster module. Let's see if we've got another one, taking it from this swing low to this swing high. No, we don't. And we do have the reversal on the smaller time frame, a double bottom, which is bullish in itself. So we do have several reasons to support of this, in addition to the monthly pivot. So it looks like a good trade long, targeting the previous swing high at least. So essentially, you should just use the weekly or the monthly pivot as a confirmation and to identify whether we're in phase 1 or phase 2. Don't just trade off the weekly or the monthly pivot on its own, because it's just not strong enough by itself. You'd always ask yourself, what else is in support of this?